On and talk about the bigger picture. Tony Drake is with us, CFP of Drake Associates. I want to talk about this past week. This past week where we saw the NASDAQ down 2.8%. The S&P was down almost 2.3%. The Russell got hit hard, 3.8%. And then the question now becomes, and this was the worst week in 5 months. Is this an opportunity or is this a shift?
Well, I think there's a couple things that are lending me to believe that it could be an opportunity. There's the technical charts, and then there's what we're seeing in earnings. But if you look at the credit markets, still really strong, right? Those are holding up, which is always a great sign as we kind of rebound out of this slump, if you will. And we're getting this building sense in the markets that, although inflation is going to be stickier, we're continuing to see growth in earnings, and that's keeping things positive. That keeps markets more comfortable with that 2% target that the Feds have hit. So I think at this point, at least, soft landing is the consensus. If you look at the technical charts, I think that's also supporting it. We had our low back on October 14th. There's been a couple counter trend moves. This one we saw last week could be the third sell-off, but there's some great support lines there. In particular, if we pull back to that support line and then rebound, that could mean some really continued growth as we continue this trend forward.
And, of course, the inflation data, I know you're waiting on that because that could sway your investment strategy, or no?
Not a lot. I don't think we're going to get any big surprises this week in CPI. I mean, I think all eyes really are on corporate earnings. Today's really kicked off the last leg of what's been considered a stronger corporate earnings season. Of the 85% of the companies that have posted their quarterly results, about 80% of those have exceeded Wall Street's forecasts. And I think there's pretty clear evidence there on how we come out of this recession. I think it's looking like it's going to be more V-shaped. We're getting this earnings snapback that's happening, and there's a lot of positive signs on the earnings front. On average, they are down about 6% year over year, but they are up 6% over expectations, and that's what's fueling this continued rebound.
So in the meantime now, when you're seeing what's going on in earnings season, how did you feel? Because it looks like we got mostly beats, right, at this point.
Yeah, and if you look historically, it is usually, it outperforms, whether it's from the down or the upside. But I think it has been surprising to so many of us in this economy, and the markets have been surprising. And they've really handled this tightening pretty well. I mean, the earnings, to your point, have surprised, but there's been this extraordinary market expansion. And, there's this AI craze. I think we need to be a little bit cautious with AI. It can be misleading. Kind of looks like the bubble that happened in 1999, right? All these companies are scrambling just to figure out how to use the words AI in their quarterly reports. But I think in a large sense, that's not affecting all of us yet. And you look at some of these multiples that are happening, and they look a little bit scary. So you definitely have to be careful when chasing technology companies at these type of multiples.
You seem to be, I guess, somewhat confident in the credit markets at this point, when you say the credit markets are still sturdy. But there is some concern about tightness and that the credit markets could, in fact, cause an economic downturn, moves in labor not in a good way.
Yeah, we're definitely watching that labor market, right? Because there's definitely been some expansion finally. Not only is unemployment looking well, but we're seeing some wage expansion. But I think in large part, the credit markets, you certainly have to keep an eye on commercial. I think that story is yet to be told. There's so many large cities that just have a ton of vacancies, and there's going to be a tipping point when that comes into a credit crunch issue and people can't make those payments. So I don't think everything is solved there, but I think a lot of the bank credit issues that we were worried about in large part, we've seen what the Feds are going to do. They're going to step up, guarantee the deposits. So in large part, some of those concerns that we had earlier in the year that you and I even talked about just aren't there today the way that they were. I think there's so many eyes on mega caps, right? But we saw a big pullback in the mega caps over the last week. And I think you have to ask yourself what your exposure is to this. Are you market cap weighted? Are you equally weighted? We're leaning towards the equally weighted on those mega caps right now. You're certainly going to miss some of the run up, but from a risk management perspective, it should fare well over the long term.
Equally weighted on the mega caps. So that's the strategy, at least for now. It's great to see you, Tony Drake. Thank you so much, of Drake and Associates. Later this